Not all waterfalls are created equal. If you're not sure exactly how your deal's structured or how your preferred returns are going to work for you, then ask your sponsor or syndicator for clarification. Look for some examples. And if you're not sure, just throw some numbers out there and say, based on $100,000, how does this work? What are my annual returns? Is it cumulative? Is it compounded? Non-cumulative, non-compounded? And make sure you understand that before you write the check. Hey, what's up, everybody? This is Brian Lucier with another golden nugget on the Why Not Real Estate podcast. And in the previous podcast, we spoke about how general partners get paid on a syndication deal. Today, we're going to switch it over and take a look at how limited partners get paid on a syndication deal. Well, there's all kinds of different ways, but we're going to just focus on 5 of them today, okay? First one's going to be the profit split. We talked about that in a previous video, but now we're going to look at it from the limited partner side. We're going to look at waterfalls and preferred returns. Waterfalls are real pretty to look at, but we're going to explain that in the essence of a limited partner and what that looks like and what that means. We're going to unpack a little bit about cash flow from the general operations part of it, what that looks like and how that might function. And then we're going to finally wrap it up with proceeds from the sale of the asset or proceeds from the refinance on the debt of the asset. So let's boil this all down, unpack it, and let's get started and dig in. So first, we're going to talk about the profit split. And again, after the income and the operating expenses, the debt service, and any capital improvements, all of those expenses are paid. Then we're looking at the after-debt cash flow. The after-debt cash flow is where we start to look at a typical 30-70 split on a deal. And if it's a typical deal with a 30-70 split, 30% is going to the general partners and 70% is going to the limited partners. So what does that all look like? When we get the after-debt cash flow, that's going to have the distribution, and we'll unpack that. This could be paid out either normally monthly or quarterly, or as predetermined in the written operating agreement. Each limited partner would receive their distribution proportional to their stake of the percentage invested. That would be on their capital contributions into the deal. I was looking for the exact term here on my notes, but based on whatever they put into the deal, their pro rata would be based off of that percentage. Okay, so now let's look at a preferred return. Preferred returns are usually called perfs, or they're called waterfall. There could be multiple forms or levels of a waterfall in a deal, depending on the contributions for each partner and the type of structure of the general partner. One good thing about perfs or waterfalls, they're motivated to keep the general partner in alignment with the limited partners, because they're not going to get paid until the property starts making money. So for a general partner, if there's a perf or a waterfall in the deal, they really want to make sure that the deal is going to function and create a cash flow. Otherwise, they're not getting paid. So that's something to keep in mind when you're looking at possibly investing into a deal. So a preferred return is an attractive option that will put investors into a limited partnership and put them in a better position. If the profit split is 30-70, 30 being the general partner, 70 being the distribution to the limited partners, then think of a preferred return as a bucket that needs to get filled before the 30-70 distribution takes place. That's why they call them a waterfall, because water will dump into one bucket and then overflow into another bucket, into another bucket. So that's the whole essence of a waterfall, how it flows. So until the preferred return is paid out annually, the general partner does not get a distribution. The general partner is highly motivated to make sure the deal is profitable to fulfill the waterfall preferred return obligation so they can start getting paid too. So how exactly does a preferred return work, and why do you care? So a preferred return, let's use an example that you have $100,000 invested into the deal and your preferred return or your waterfall is 8%. That means you're going to get 8% annually on what your unreturned capital investment is, your capital contribution, your unreturned capital contribution. So if it's $100,000 in annually at 8%, you're going to get a perf of $8,000 a year before any distribution happens. So if your preferred return is based on the unreturned capital contributions annually in a $100,000 investment example, if $50,000 is returned to the limited partner, either through a refi or some other event at the property, typically during a refi, if half of your money on $100,000 is returned to you, then your new preferred return is going to be based on the remaining unreturned capital contribution in the deal. So if it was $100,000 at 8%, used to be $8,000 annually. If through a refi, the general partner paid back $50,000 on that $100,000 investment, your new preferred return is going to be based off $50,000 at 8%, or it would now be lowered down to $4,000 a year. And you would still have to receive that first before any other type of split or any other type of distribution were to happen. Now, there's a couple other hubcaps, bells and whistles that could go on a preferred return. A preferred return can be cumulative versus non-cumulative. So let's say for our example, the property did not hit distributions for a given year. It was the startup, capital costs were higher, whatever it is. In a cumulative scenario, the perf rolls forward to the next year. So that $8,000 would roll forward on $100,000. If it's non-cumulative, then it goes away. So you kind of need to know what's going on. You have to ask your sponsor, is this a cumulative or non-cumulative? The next level you might consider or see in your syndication deal are the preferred returns to be compounded versus non-compounded. So what does that mean? That means if it's cumulative, say that 8,000 rolls forward and it's compounded, you're going to get interest on top of that cumulative. So that would be cumulative plus compounded. If it's not compounded, then that cumulative that rolls forward would not have any other interest on it. So again, these are fine little minutiae details that you have to kind of look at. Each deal is different, each waterfall is different. And that's actually the fifth point I want to bring up about how a preferred return works. Not all waterfalls are created equal. If you're not sure exactly how your deal is structured or how your preferred returns are going to work for you, then ask your sponsor or syndicator for clarification. Look for some examples. And if you're not sure, just throw some numbers out there and say, based on $100,000, how does this work? What are my annual returns? Is it cumulative? Is it compounded? Non-cumulative, non-compounded? And make sure you understand that before you write the check. So the last two parts we're going to look at on how a limited partner gets paid. One is going to be the cash flow from the general operations. Well, actually, let's unpack that. That's more of the 30-70 split. So what happens to the cash flow after a preferred return has been satisfied? Okay, so a couple typical examples could look like this. First example, the limited partners would receive their 8% return, preferred return, and then based on their unreturned capital contributions on a pro rata basis, which is determined by the ratio of each investor's capital contributions, they would then receive their portion of the 70 in the 30-70 split. The second example, a typical 70-30 split takes place to the investors on a prorated basis. based on their unreturned capital contributions. In plain terms, this would be an 8% preferred return followed by the 70-30 split, 70 going to the limited partners and 30 going to the general partners. So that's your basic cash flow on a deal. Perfs and waterfalls happen first. After, when you get to your after debt cash flow, everything splits from there. Okay, now the last two things I want to look at are the proceeds from the sale of the asset or the proceeds from the refinance on the debt of the asset. So if the property sells, then this cash flow is treated like any other distribution, except it's to occur before the preferred return or waterfall and the 70-30 split. So why does that happen? So that money comes off the table first. It's split proportional to the investment, the pro rata investment for each limited partner or general partner in the deal, if the general partner is on the LP side of it. That happens first. Then, after the proceeds from the sale are distributed, the 8%, if it's 8%, preferred return happens, then the normal 70-30, 30-70 split, whatever that is. So the capital received from the sale of the property is to be distributed to the investors on a pro rata basis up to the extent of the unreturned capital contributions. Then the normal preferred return and agreed upon split would take place. So the last part we're going to look at is proceeds from the refinance of debt. And we talked about this a little bit in how the general partner gets paid if there was some hurdle or refinance fee. This would happen after that as well. So the money obtained from the refinance is handled similar to the proceeds of the sale of the asset. The only difference in distribution is applied to the pro rata on the unreturned capital contribution. For example, if there was an 8% preferred waterfall on $100,000 and the refi returned $50,000 toward the capital contribution, the new unreturned capital contribution is now 8% of $50,000. So on the refi, if distributions pay off half of the $100,000, then the remaining $50,000 would have the preferred return. So on the original example, $100,000 at 8% annually would be $8,000 a year. Now that 50% has been returned to the limited partners through a refi event, the remaining $50,000, still getting 8%, would yield a $4,000 return preferred waterfall. So that's in a nutshell on the limited partner side of it, how a limited partner could get paid from investing in a deal. Again, all deals are different, all limited partners, the way they split up the deal, preferred returns, not all waterfalls are the same. But make sure if you're dealing with a sponsor or a syndicator that you understand the terms and conditions that they're putting out there on the table. And if you're not sure, ask questions. They should be able to explain it very simply. It shouldn't be overcomplicated. Preferred return happens first, then the split. So that's where we are in today's Golden Nugget. This is Brian Lucier from the Why Not Real Estate podcast with another Golden Nugget. Wishing all my peeps out there all the best. Thanks. See you on the next one.